Hey, Market Chameleons and Dimitri Pargamonic. I was so enticed by an email I was reading. I almost missed the start of the show. Sorry, D. That was
no problem.
Thank God you called me at the last second. I would have gone another 15 minutes reading about Ethereum. Crazy.
Yeah, no problem. I was starting to panic when I didn't hear from you.
Good stuff. Do you want to get going with the disclaimer? What do you think?
Yeah. Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. With that,
let's get started with some earnings. What do you think?
Yep. So let me share my screen real quick. I think 1 second. Well, I think you're still sharing yours. So.
All right, let me stop.
Let me just stop.
Yep, there you go.
Do you see mine?
Yep.
Okay. So I think what we'll do is we'll start with the pre-market report, take a look at what's moving in the pre-market hours. We could take a look what's coming up on the earnings front, a couple stocks reported earnings, some big ones, Microsoft, Google reported. So I'll take one of those, maybe see, maybe get some insights from there. We have a couple new reports that I've been showing that we've been starting. I think one we released, some of them we're expecting to release later this week. So I'll go over a couple of the new reports just so you guys are a little bit prepared once we push it out to know what's going on with those reports. So, and if you have any questions along the way, Will, let me know. I'm going to try to answer as many of those questions as I can before the end of the show.
Perfect.
I'm on the pre-market report right now. Find it here under stocks, pre-market trading. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to use this filter here, market cap, to see what's going on in the higher market cap stocks, so 20 billion market cap or higher. And we see here 19 made the percentage gainers list, 20 on the percentage decliners list. From that perspective, pretty neutral for the opening. We see some big names here. I think Google reported earnings. That's up 5% in pre-market hours. It's DB Deutsche Bank, I believe. They're up 9% in the pre-market hours. Shop reacting to earnings up 4.6%. And we got a bunch of, see these little E's here on the alerts. That's all if they've reported earnings yesterday after the market closed or today before the market opens. The stock's reacting to that news. So you got that little indicator there with an E. And if you just want to see earnings, you can use these filters here and just say has earnings. That will just filter out stocks that either had earnings yesterday after the market closed or, again, today before the market opens. Before the market opened, they reported, were given that indicator really quickly. So from that perspective, we see here that even with the earnings, 9 stocks reported earnings are up, 10 reported earnings are down today. And, that looks also kind of like a neutral half and half. There are no questions on the pre-market, Will. I might just start moving on to cover some of these other reports that we've been talking about.
Sounds good, D.
All right. Actually, before I get to the report, let's see what's coming up on the earnings front. So I'm going to go here to the earnings, upcoming earnings. And we talked about these 4 tabs already earlier this week, but basically these are looking at analytics for stocks that are expected to report earnings in the next 2 weeks. I'm going to use this filter here, average option volume, and look for stocks that on average trade at least 5,000 option contracts per day or more. And then let's switch to this full report next 2 weeks. And we could see here, these are the symbols. Here are the dates they're expected to report earnings. This is their average option volume. This is the implied, what the option straddle is implying the earnings move. So when you're buying a call, buying a put, you're paying premium for both. So the stock has to move either up or down by a big enough percentage to cover the cost of that premium, right? So that's where the implied move is coming from. So some big ones here, eBay, looks like maybe with the Deutsche Bank report today already, that might have already reported because I saw that on there. Another big one, Apple, that's today after the market close. So we got a bunch of them just today after the market close. Qualcomm, Facebook, so a bunch of these are reporting today after the market close. We could go over any of these if there are questions. I just wanted to point out what's coming up.
There were a lot of people asking about Apple. I don't know if you want to dig into Apple a little bit further.
Okay, so here we see this Apple right here, expecting to report today after market close. That straddle right now is implying a move of 3.7%. So that's what, that's how much it's going to cost you to buy that at the money straddle, 3.7% in premium. So the stock has to move beyond that for it to be profitable from the long side, from the buy side. If you're selling it, then the stock has to move less than that. So if you collect that premium, stock moves less than that, then the premium will come in. So how does this move compare to historically? How did Apple move after reporting earnings, right? That's the question. Right now, we don't know what's going to happen tomorrow, but how does this compare to historical moves, and are we on the high end, low end? Are we like right there? That's kind of like the first question we have. So let's compare it to the last 4 quarters, and then we'll compare it to the last 12 quarters. So in the last 4 quarters, there's the last 4 quarters. If we take Apple and we say, what is the average move after reporting earnings? So Apple reports earnings. It's after the market close. Obviously, does the next day is the trading day. So how did Apple do the next trading day, right? On average, in the last 4 quarters, the average move, right? Average move was up or down 5.3%. So that's the magnitude of the move we're looking at, 5.3%. The high move in the last 4 quarters, 10.5%. The low move, 1.6%. Okay, so that's in the last 4 quarters. What about the last 12 quarters? So in the last 12 quarters, on average, Apple moved 4.7%, up or down 4.7%, high move of 10.5%, low move 1.6%. So if we compare the expected move heading into earnings versus our historical benchmarks, right now we're looking at, based on last 4 quarters, we're 1.6% below that historical benchmark, 1% below the 12-quarter historical benchmark. So if you feel, in other words, if you feel like Apple is due for a big move, we could do some more analysis, maybe make an argument either way. But if you feel like Apple could potentially have a bigger move than historical, then here, this data is showing us that you're getting a pretty good deal heading into earnings, right? So even if we're looking at a average move, we're getting a good deal, right? If it's just going to move what we think on the average, or if we think that it's going to potentially make a bigger move than usual, then that straddle seems relatively less expensive than historical average. Historicals are suggesting. What about that? So those are comparing it to the actual move, right? What the stock actually moved. What about what the straddle usually is priced heading into earnings? In other words, well, we know that's what it actually moved, but are historically, are the price, is that straddle, priced in line with historical averages? So now we're going to compare it to what were the straddles priced at on average day before earnings. Okay, so in the last 4 quarters, we're looking at an average of 4.9%. Last 12 quarters also average 4.9%. So even from that perspective, those options, as far as like premium goes, that's 1.2% below the historical averages. So at least the market right now is telling us that they think Apple's earnings reaction will be more muted than historical averages. Okay, so that's really quickly from from this screener. Of course, you could go to Apple and change the data to less years, more years, whatever you want, but this is giving us kind of an initial viewpoint, right, from two different benchmarks, 4 quarters and 12 quarters. Is that okay with everybody so far?
Yeah, I think everyone gets that.
All right, so I'm going to go to Apple right now just to kind of show you graphically what that looks like. So when I click on there, this will draw us a graph of, right, this. So let's just explain this really quickly. These are the last 12 quarters, okay? These bars here, these bars up and down, that represents that implied move we were talking about, right? So you could see here starting from 0, what is the expected move up or down, right? So that's what this bar is, up or down, that's what the straddle was implying. The red bars and green bars, those are the actual moves. So the red bar, that's if the actual move was down, it's showing up red, up, showing up green. So in this example, January 27th, after the market closed, Apple reported earnings, they were down 3.5%. The next day, that the straddle was implying a move of 6.8%. So you could see here that move was inside the expected range. So if you bought that straddle, the next day, didn't move by enough. If those implied vols came in, that would have been a loser from the buy side. Here, that's for this example, on July 30th, after the market closed, Apple reported earnings. They were up 10.5% the next day. The straddle day before was implying a move of 3.6% up or down. So you could see that move blew right through the straddle. So if you sold that straddle 3.6%, premium stock move 10%, you're buying that straddle back for more money, resulting in a loss. Hopefully that makes sense. So let's just take a look at the historical averages. So here, the options market overestimated the move 58% of the time. Okay. On average, the move heading into earnings, the straddle was implying a move of 4.9% in either direction versus realized move of 4.7%. So they're kind of close, pretty close here. But what we could see here is that even though the actual move, right, was a little bit below the implied move, those straddles on average 50% of the time were winners, 50% of the time were losers, for an average gain of 6%. So why is that? Well, one reason is that even though these moves were pretty close, they were in line, there's still some premium left, right, in the option straddle. So those could have actually resulted, when you're this close, right, when you're this close to the actual move versus realized move, the straddles are probably a good deal because you get the move and you probably still have some premium left in those options because they don't automatically go to 0. So from that perspective, you see that the straddle from the long side, if we're looking at the long-term averages, they were profitable from the long side. Okay, I'm going to take a look at the implied volatility really quickly, but I'm going to move fast unless there's questions so I could get to the other reports. So Apple, how did the implied volatility do after reporting earnings? So we're looking at a 30-day constant maturity option. The near-term options, they're mostly gamma, so you're playing the move like we were just talking about. As you go out further in time, those options have more premium and more vega risk, more time decay risk. So how did the 30 options with 30 days to maturity, not the very near term, 30 days to maturity, what did the implied volatility do after Apple reported earnings? So we see here, on average, implied volatility was down 21% day after reporting earnings. Average implied volatility day before earnings, 34.2. Average implied volatility day after earnings, 27.4. 5 days later, continued to decline, 25.6. So those are people playing calendar spreads. See, we got here strategy examples, calendar spreads, diagonals. You know, you're doing options, two different expirations, or two different expirations and different strikes. That's a diagonal. You want to pay attention to not only the move, but the potential implied volatility change day after reporting earnings. So those are your reference points right there. If there are no questions, because I'm already halfway through the show.
We did have another question. 2 people actually asked about Ford's upcoming earnings.
Ford's, okay. So Ford, that's also today after the market closed. So let's just do the same thing here. This is the historical implied moves versus actual, right? So you got your graph over here. What happened? So half the time, it looks like the options overestimated, half the time they underestimated the move. On average, in the last 12 quarters, the straddle was implying a move of 6% heading into earnings versus the average realized move of 5.3%. So you could see there about a 0.7% differential, not that great. So you could see here, half the time the straddle was profitable, half the time it was unprofitable, but on average, in the long term, you broke even. And that's because the moves were pretty close to where we were expecting, you know, a little bit under. But obviously, if you still have a little bit of premium left, right, they don't go all to like straight, the premium doesn't all get sucked out right away. So it looks like, you know, those straddles were break even on average in the long term. Okay, so that's from the magnitude of the move perspective. Let's take a look at the implied volatility. So here we see 30-day constant maturity. On average, that implied volatility day after earnings was down 19%. Day before, the 30-day IV day before earnings was 44, which is close to where we are now, right? 40, we're at 42. Day before, 44. Day after, average implied volatility fell to 36%, 36. 5 days later to 32. So it looks like it continued to decline, you know, in the next 5 days. So that's really quickly your perspective from earnings move and implied volatility. Okay, let me just see really quickly. I just want to see here right now. This is where we are. So didn't report earnings yet. So you could see here that the options are implying a move of 5.3% heading into the earnings, which is really right where the historical mean was for the actual moves, but we are below where the straddle was usually priced on average. Any questions there?
None. They also, thanks for looking at it.
Yep. Okay. Let me see. Since I have 10 minutes to go, I'm going to let's look at the company earnings guidance. Okay. So this is a new report you guys have available right now. I'm going to go really quickly, like just to describe what's going on here and just give maybe a use case. So when a company reports earnings, you know, they'll tell you how they did in the last quarter, right? So they're going to give you an update. This is how much revenue we made, earnings, gross margins, and then management will sometimes give you an outlook going forward, right? So the outlook going forward is probably even more important than what they've actually reported, because when you're investing in a company, really what you're investing in is how is the company going to do going forward, right? Like, okay, you might have done great last quarter or last year, but if you think that the business is heading north or heading south going forward, you're not going to reward that stock. And even if maybe you didn't do so well historically, but if you think things are turning around and going forward, earnings and revenue are going north, the stock's going to get rewarded because it's looking forward looking, right? Stocks are forward looking, not backward looking. When a company gives you those guidance, that's important because you're kind of getting the look from the inside. So an analyst doesn't know as much about a company as the management itself, right? The management is the closest to the data, the closest to what's going on inside the company. And really, analysts are getting guided themselves by the outlook that management gives us going forward. And that's why this is important. When we looked at, and we're compiling this right now internally, we got a bunch of people working really hard to get you these numbers. So you could see here, these are today's announcements, April 28th, a list full of forward-looking guidance that was issued by these companies that are reporting earnings. And sometimes they might give that guidance even in between earnings. So, a lot of times they report earnings, they'll look for the guidance, but even in between earnings, they could raise their guidance, issue guidance, or lower their guidance. So that's very important to follow. So let's take a look at one example here. And I know Microsoft, because this one I actually was looking at, and I did some, and I entered this in. So Microsoft reported earnings yesterday, and they did give us some guidance, and this here is for the fourth quarter, right? So the next quarter, what they're telling us is they think their revenue is going to be between 43.6 billion, 44 billion. So if we compare that to the same quarter prior year of 38 billion, we see they're expecting 16% increase in revenue. So 16% growth in revenue. They also gave us some guidance on gross margins and operating margins. All right. So now that we got these numbers, we kind of say, okay, looking forward, we see that they're expecting to grow. They're not expecting to decline or stay flat, so they are expecting to grow. So we want to compare that to historical growth rates, and they gave us gross margins, operating margins. We want to compare that to historical, and then to the rest of the market to see like where we think Microsoft could potentially be priced. Like where's the value, if we could put a valuation on Microsoft using a theoretical model. Okay, so we're going to try to see if we could create a theoretical model to see if Microsoft's fairly valued. So I'm going to go over here. Now remember, theoretical model is just, this is what we think in theory it could be worth. All right, so Microsoft, and it is down a little bit in a pre-market, and I didn't read the whole thing. It's up to you to go read everything that the management is saying, and maybe they're disappointed somewhere or whatever it is. They are down a little bit. I'm just going to really quickly just take a look at this is what they reported, $1.95. The expected earnings per share was $1.78. Those are the consensus of the analysts, right? So they beat the analysts' consensus by 17 cents. Revenue, they reported 41.7 billion versus consensus estimate 41 billion. So that's a beat by 676 million. The stock is down, and we talk about that a lot. Keep in mind, it's not if they just beat analysts' expectations. There's other things going on here. Are they beating the actual shareholders' what were the shareholders expecting? The actual people who hold the stock, because analysts don't hold the stock. They don't determine what the stock's value is. Those are the shareholders, people buying and selling in the market. And then the other thing is that the guidance going forward, right? So even if the guidance going forward isn't as good as what people are expecting, that's also going to impact the stock. So we see here down right now in the pre-market hours, slight about 2.2%. I'm going to take a look at Microsoft's fair value. I'm going to try to be quick about it right now because we only got 5 minutes to go. So the first one, this is comparing what we think the implied value of Microsoft is if we used historical multiples, PE ratio, price to sales, price to book. You know, we use the 3-year average, which you could change here. You could go 5-year average, 3-year median. Just defaulted to 3-year average. If we look at the historical multiples over here, and then we compare historical multiples to the rest of the market, I'm going through quickly. We get on average the implied value 230.73. Right now 261. Microsoft's 261. So from there, it looks like a 13.5% premium. Remember, these are using multiples, historical multiples, and these multiples are always trailing, right? So you're using trailing 12 months to calculate PE, price to sales, and so forth. What if we looked at forward looking, right? So that's using just historical numbers, but like we said, what if we added, growth rates going forward, and Microsoft already indicated to us they think they're going to grow by 16% next quarter, right? They gave us their operating margins. So I'm going to use this next model. And this is going to look at forward-looking estimates and comparing it to the rest of the market and saying, well, if we price Microsoft where the rest of the market is pricing growth, return on investment, volatility, where do we think Microsoft would be, the fair value or implied value would be? So let's just go through this really quickly on our calculator. We're going to look at a couple things here: operating margin, revenue growth, and volatility. So operating margin is what percentage of their revenue is left over as profit from their core business. Okay, so if they generate $1 in sales, how much do they get to keep from their core business as profit? So here we got 37%. That's the current one is 37%. So we could see that operating margin has been growing. 5-year average 30%, 3-year average 34, currently 37. So I'm going to keep it at 37 just because, so far that's where they guided us for the next quarter, 37. So I'm going to keep it going forward the next 5 years on average 37. And if we compare that to S&P 500, SPY, we could see SPY 9.8%. Okay, so that's the operating margin. If we took the overall market using S&P 500 versus Microsoft. What about revenue growth? So we see that Microsoft, if we use the 3-year average revenue growth, year over year, they grew 17% year over year. Okay, that's compared to S&P 500, 4.4%. Now we could change these numbers, okay, but for now, let's just keep it as we think if the last 3-year average will persist the next 5 years, okay, for both Microsoft and S&P 500. And I could just see, what did Microsoft tell us so far? We see that they think revenue is going to be next quarter in this range. If we compare it to last year, that's a 16% growth. So at least for the next quarter, they are seeing about 16% growth. I mean, look, I'll take this down a notch. Let's take it down. Let's take it down, let's take it down to 14. Okay. Maybe we won't be as aggressive on there. And I could take this down a notch too. Let's take this down. I could take it down to 34. All right. So let's say the next 5 years, Microsoft, on average, their operating margin will be 34.3. In other words, for every $1 in sales, they're going to keep 34 cents as profit from their core business. And their revenue is going to grow by, on average, 14.2%. Okay. Let's just leave this volatility alone for now. And I'm going to recalculate this. If we use this, right, then we think the implied value of Microsoft is 294 versus the market price right now, 261. So how do we get there? Let's just compare this really quick. And I'm at 9:30 right now, Will, but I'm going to just take another minute to go through it.
Sounds
so
good.
if we took the S&P 500, 5 years, we see right now the market cap of S&P 500, everything is 37.9 trillion. And in revenue, they generated $12.2 trillion. Microsoft, market cap 2 trillion, revenue they generated $153 billion. So if we look at SPY and we say, well, if their revenue grew 4.4% year over year, right? So if this is our starting point, next year revenue grows to this, third year this, third year this, fourth year this. So you could see every year it grows by 4.4%. Same thing in Microsoft. Every year this is going to grow by 14.2%. So this is for 5 years. If we think that S&P 500 operating margins is 9.8% out of this revenue, this is what they're going to keep in profits. 9.8% of it will be profits. In Microsoft, 34.3%. These will be the profits. So if we accumulate it for 5 years, in S&P 500, $6.8 trillion in profits versus Microsoft, $398 billion. Today, market cap of S&P 500, 37.9 trillion versus Microsoft, 2 trillion. So the return on investment in S&P 500 is 17.9% versus Microsoft, 20.2%. So you can kind of see it here. So Microsoft there, if we remember, these are all estimates and assumptions. If we use the assumptions that with the revenue growth and operating profits, right, which we could change. Based on that, we see that Microsoft will return more. In other words, if you just bought all the stock in Microsoft and got to keep the profits, that's a better return than if you just bought all the stock in all the companies and kept the profits. So what would Microsoft be priced at to make this equivalent return? $294. All right, so you're getting a little bit of a discount. Again, these are estimates. Doesn't mean that it has to be there because nobody knows what's going to happen in the next 5 years. We're just kind of using our data to create estimates to see benchmarks, how far away they are. That's all the time I have, Will. There are no questions.
Excellent job, brother. Another great episode. So cool.
Okay. All right. Thanks, everyone. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Trade in peace, chameleons. Have a great day.